Welcome to Market Masterclass, and we're talking about investment vehicles, and this includes direct ownership, exchange-traded funds, closed-ended funds, hedge funds, private equity, and this one is perhaps the biggest of the whole area. This is mutual funds, often known as open-ended funds, and this includes unit trusts and investment trusts, and this is a massive market worldwide. This is, you're picking experienced fund managers who are picking particular areas to be investing in worldwide. It could be in India, it could be in China, it can be specializing in South America, and it can be specializing in commodities, it can be specializing in oil, it can be right across the board. And basically what you're doing is you're taking somebody with expertise, you're putting a little bit of money, you can get in with quite low amounts, and you're pooling your resources with a whole flood of investors. And those fund managers are picking stocks and picking investments worldwide in the chosen field that you've gone into. There are low risk ones, there are medium risk ones, there are high risk areas. So you've got a whole world there. A lot of the main international insurance companies give you access through a portfolio bond where you can choose 5 or 10 or 15 different funds under one umbrella. So you can access the whole world of investment. So mutual funds is a major market for investors worldwide. You've got the investment, every fund has its own investment objective. It's trying to get capital returns over a long term. If it's a bond fund, it's investing in government treasuries. You're dependent on the dividends that are being paid out. You're depending on the interest rates which are being paid out. But the baseline is you're looking for capital growth. And that's where the mutual fund market is, that's where their expertise is. And you can assess what quality the fund has got, because S&P will rate the fund, whether it's A rated or B rated or C rated or D rated. D rated means that it's more risky, it's not quite so qualified. A rated, of course, is a top grade, and you're getting in with the big boys like Fidelity and JP Morgan and all the names that are very familiar worldwide. Entry costs, let's talk about fees. They have an entry fee, sometimes it's 1%, sometimes it's 2%. If you go into what I call a portfolio bond, where you've got an umbrella where you can choose different funds, that insurance company will also charge you an entry fee. They may also charge you an exit fee, so you might have to stay in for 4, 5, 6, 7, 8 years. If you come out early, you'll get a back-end charge. So there's a different layer of investment fees on top if you're going into a portfolio umbrella, but you get access to the whole world of investment, because one insurance company might give you access to 150, 200 different funds, so you can choose a very varied portfolio worldwide. And you're looking at, as I say, if you're in bonds, you're looking at dividend returns. If you're in equities, you're looking at capital growth. And these fund managers are choosing, with their expertise, normally based in the countries. So if you're in a China fund, the fund manager is based in China. So this is a very massive market, and the main way that most investors get into the market by giving that expertise for them to choose the portfolios that they're building. Very important. They're normally open-ended, as I mentioned, because you can come out quite quickly. You're not locked in for long periods in the fund itself. So they have a net asset value that they quote a price on a regular basis, and if you want to sell, you can sell. If you want to buy more, you can buy more. But they're very liquid, you can come out on a regular basis. So that's the basics of mutual funds, otherwise known as open-ended funds, and that is a very popular way to get into all sorts of markets worldwide. Thank you for your time. See you next time. Take care. Bye for now.